So good morning, everyone. Thank you so much for taking your time out and joining us on the next webinar in our webinar series, Deep Dive with IIQ Experts, the free webinar series. As many of you already know, we conduct this series of webinars on important topics pertaining to our industry for disseminating important knowledge areas. So today's webinar is a webinar on Python for financial market analysis. And we are extremely glad to have with us Kumar Saurav, who will be our guest speaker for this webinar today. So just to give a brief introduction of Saurav, Kumar Saurav is founder of Scientific Investing, where he teaches wealth building concepts related to fundamental analysis, technical analysis, quants, and algorithmic trading. He has been a visiting faculty to multiple B schools, including the IITs and IIMs, Praxis, B school teaching courses related to data science and finance. He has a vast 15+ years of industry experience spread across analytics, consulting, data science, and financial due diligence across multiple sectors. He has been recognized as one of the top 40 under 40 data scientists as MLDS 2019 by Analytics India magazine. He has worked with technology and consulting companies, including Ernst & Young, DXC, VMware, HP, ICRA, TCS, etc. And he is also an active investor and researcher with more than 10 years of experience in Indian equity markets. His posts, his views on financial markets through social media handles, like Twitter, where he has more than 50,000 followers, and his YouTube channel also has more than 24,000 followers. And more multiple national forums. So welcome, Saurav, and thanks for joining us.
Thanks, Nitish. Thanks for the kind introduction, and it is great to join this teamed forum. And I hope next 1 hour is going to be, useful for all of us, and we learn something out of it. Thank you.
Yeah, absolutely. We are sure. I mean, your sessions are always very interesting. But before I hand over the session to you, what I'd like to do is I'd like to give a brief head sound on how we would go about the session. So most of you already know that this would be about 1.5 hour session where Saurav will be talking about his topic rather, the topic of the day, for about almost about 45 to 50 minutes, and then we'll have the Q&A. So since we have a lot of participants, generally, or rather unfortunately, we would not be able to allow you to speak up, but nonetheless, we want the session to be as interactive as possible, and we would like to answer as many questions as we can. So please feel free to type in your questions in the chat window, and we'll be happy to take up all your questions during the Q&A session after the webinar. Right. So with that, we will hand over the session to Saurav. So all participants, we all will be on mute. Only we'll be able to hear Saurav, and we'll be able to see his screen once I make him the presenter. For all your questions, please feel free to type in your questions in the chat window. So with that, I hand over the session to Saurav. Saurav, all yours.
Thanks, Nitish. So I hope I can share my screen. Yeah. Let me know if my screen is visible.
Yes, we can see your screen.
Okay. So hi everybody. Today we are going to talk about an interesting concept in quantitative finance. This is regarding a programming language called Python. So I'll be speaking about the importance of Python for financial markets because it is one of the key ingredients whenever we think of quantitative finance or application of computer science or application of programming language in financial markets. So what we will do is, in terms of agenda, the first thing is why to use Python, because already there is fundamental analysis, there is technical analysis. So there are so many things to learn. So there is one more thing we are adding. So of course it has to give some value. So we will try to understand why Python for financial markets. Then we will try to understand where to use Python in financial markets. And then we will try to go through some case studies to establish the usefulness of Python in financial market, and also to learn very basic level how to do it, whether it is financial fundamental analysis, whether it's algorithmic building, or whether it is something else to be done. And then we will have a Q&A session. So that is going to be the flow of the presentation. Just one thing, I've just come out of viral fever. So in case my energy is a little bit low, please bear with me, though I'll try to ensure that, I keep my energy levels high. So first thing first, whenever we think of financial market, why financial markets exist, and there is one and only one reason. They exist for making money. Anybody who enters into financial market, they enter with a view of making money. Whether you do investing, whether you do trading, whether you invest in currency, whether you invest in equity, whether you invest in commodities, whether you go long, whether you go short. But for everybody, the common goal is to make money. And to make money, there are certain questions which are common and which are most important. I'm thinking more from a long perspective. Like, I'm not a short guy. I usually do only long transactions. That is why. Else you can start with what to sell also. But I mean, the flavor is basically you want to understand what you have to buy or sell, like what is going to create wealth, when you have to buy, because timing is also important. India looks a great market because India has always created wealth, but there are a lot of countries where even after 10 years, no wealth has been created, or there have been asset classes where for 15 years no wealth has been created. Like gold, it hardly gives 6% CAGR between 1982 to 1989. So all said and done, for don't try to time the market. The fact remains, in pockets, timing the market is also important until we are in a kind of secular bull market kind of country. So when to buy is important, how much to buy, because asset allocation is important, and the same thing in reverse, because what you are buying you are going to sell someday, because until as you book your profit, it all remains paper profit. So the same questions repeat: what to sell, when to sell, how much to sell, all of that. So anybody who is there in the financial market is there with a common goal and common set of questions, and this is the common goal, and these are the typical common set of questions. So whatever we do with Python, ultimately we will be solving one of these questions with a final objective to generate wealth. So all the use cases, what, why, how of Python ultimately will be addressing these questions, because then only it is an applicable tool, else it all remains theoretical. Now, without Python, can't it be done? And given there are a lot of investors and traders who don't use Python, and still some of them, they make money. But where does Python comes, and what is the role of Python? So if you think of a world without Python or without these kind of programming languages, people could be successful, people could fail, but why they fail, there are certain reasons, and why they may not be as successful as possible, there could be reasons. And again, it depends. If somebody is having the kind of skill set where he has complete control over his emotion, his behavior, his investing style, his trading process, then it may or may not be required. But of course it adds value, and where it adds specific value is, so first, we all are humans, and we all have our own emotions and our own biases. And there are different kinds of biases, like recency bias and all of that, anchoring bias. So money making becomes difficult because of following reasons, and that is why you will see listen to these kind of statements like 99% of retail doesn't make money, 50% of mutual funds, they don't beat index returns, and all of this, which ultimately somewhere highlights money making is not that easy, apart from typical bull markets where everybody feel it's easy. And why it is not easy is because of certain reasons. So the first reason itself is all the kind of behavioral and emotional biases. Like you'll see, when there is a hot bull market going on, you will get so many new participants in the market. The students will also jump in, those who have never looked at markets will jump in. We still hear story about Reliance IPO, petroleum IPO, Right now we had a lot of pay ATM and whatnot. So there is an inherent behavior of jumping when there is too much of heatness in the market. But when markets are very pessimistic, no return has been created, nobody would like to enter, no discussion will happen. So all this is behavior and emotion, and sometimes the best time to invest is when markets are attractive. So there are different kind of behavioral and emotional biases which stop us from making money. The second is lack of experience. Not everybody is there in the market from last 10-20 years, and experience has its own value. So somebody who is new in the market, there is a saying that first cycle you learn how to avoid losses, second cycle you learn how to make good buys, and third cycle you learn how to make good exit. And the fourth cycle, if you are there in the market and you have survived these 3 cycles, then you become a good investor. So experience is very, very important, and nothing can replace the physical experience of being in the market. But are there ways to gain experience? So first, are there ways to control our behavior and emotion? Second, are there ways to gain experience? Third, many of us, we take decisions on intuition, and intuition has its own problems because you don't know what is your probability of success. You don't know until you fail. And fourth is lack of evidence. If you have a decision which is based on certain evidence and certain success measure, certain probability of success, that will give you more confidence and conviction compared to a decision where there's no evidence. Is like we all go to the shop and we try to buy things, and before that we go to online, we see the rating, and when we see, okay, this shop has very good rating or this doctor has very good rating, we get evidence, and that tells us, okay, I think my experience is going to be good. But if we don't have any rating, we get scared that, oh my god, how this person is going to be. So evidences of success always helps to build confidence. So Python somewhere helps us to overcome these kind of challenges. If we have a behavioral challenge, emotional challenge, experience based challenge, intuition based challenge, we need more evidences to say that whether it is going to work or not. This is where the role of Python come, and it doesn't mean if somebody doesn't learn these kind of languages, he can't do it. Few can do it, and those who keep doing it, keep learning, keep improvising, even with a non-programming kind of background, they also become experts, and there are. But somewhere technology is helping. Technology is changing the world. I mean, the way we shop, the way we interact, and same is happening in financial markets. So technology is changing it, and if technology can be useful, then why not to imbibe it? And that is where the role of Python comes. Also, why Python and these kind of programming languages are important. So I am taking some of the famous quotes from very famous investors or traders. You would have heard about Sir Jesse Livermore, you would have heard about Sir Warren Buffett. Everybody, whether he is a trader or he's an investor, everybody has emphasized on the importance of pattern identification. So if you look at the first statement, it says patterns don't work 100% of the time, but they're still critical because they help you to define your risk. If you ignore patterns and focus on hunches, feelings, just forget about achieving consistency. So, intuition word we saw in the previous slide. So patterns are always important, and if one can find patterns which are repeatable with a very good risk reward, he can be successful. Second, I learned early that there is nothing in the Wall Street. There can't be because speculation is as old as hills. So it says the same thing repeats again and again because it's all emotion, greed, and fear, and those are the things which get reflected in valuation. Those are the things which get reflected in charts. So whether you make money as a trader or investor, you have to find those repeatable patterns, and greed and fear, human behavior is nothing new. So it's all about finding patterns of those repeatability. So all these statements, when you see Mr. Warren Buffett, he says what we learn from history is that people don't learn from history. So everybody is emphasizing on learning from history. Everybody is emphasizing on repeatability of patterns. Everybody is emphasizing on understanding patterns which can help us to identify wealth creating ideas. Again, Robert Shiller, he is the inventor. Invented this Shiller P. So it amazes me how people often act based on little or no data or than to use data. So there's an emphasis on pattern, there's an emphasis on identifying and learning from history, There is an emphasis on learning from data, making data-driven decisions. So all of this is possible. If we are new to the market, it may or may not be possible, because if we are new to the market and you ask me what happened in India in 1990 to 2000, I was not there. Some of us were not born. We don't know. But when we have the technology, when we have the data, it gives us kind of access to go and virtually live that era and learn from what happened in that era. And that is where the role of data and the role of technology comes. And Python is one technology which leverages the data and its programming language, and then it helps us to overcome all these challenges, and it helps us to validate our intuitions, our gut feeling, our big statements. Like you will see somebody will tell, don't catch a falling knife. That's a very popular statement among traders. Don't catch a falling knife, because maybe people are scared of DHFL, Yes Bank, or whatnot. And there is an alternate statement that money is made when there is blood on the street, which is by another popular investor, Warren Buffett. So you can go and buy when there is blood on the street. That means you are going to catch a falling knife. So which is true? This is true, or that is true, or both are true, or both are wrong. So there are multiple kinds of statements made in the market, and as an investor or trader, it becomes sometimes confusing. And that is where the role of Python comes, where until you don't quantify it, until you don't measure it, statements remain qualitative statements. And that is where these languages like Python, it helps us to validate those statements, those intuitions. It helps to speed up the learning curve, because it helps us to go in the history and learn from data, even though we are not physically present in that era. It gives an alternate perspective. I might have a very bullish view, but what if my system, based on historical data evidence, is telling this time to be bearish? So whether some people can replace their decision making completely by system, some people can have system as a devil's advocate to challenge their decision, so that they don't get driven by their biases in extreme emotion. And some people just use it for experimentation. So it's a personal choice, depending on the learning, depending on the maturity curve where we are. But the role of technology is there to replace, to complement, to question in all forms of ways, and we need to decide where, at what level we are comfortable. And also it helps to improve the return on investment per unit time. By this, what I mean is, sometimes these tools and technology, it helps us to speed our learning curve, speed our analysis curve. The amount of time taken to analyze what it takes, 40-50 hours, it can be done in 10 hours. And especially on the institutional side, this is very, very important. Like the JP Morgans of the world, they have built chatbots and all, to answer the questions, skimming through thousands of reports, thousands of con calls, and DRHPs and documents, and they can search for the answer by leveraging technology like Python. So it also helps to speed up the learning curve. So I will not get into technical, and even I am not a technical guy. So my background is I worked as a software engineer for 2 years, but then I did my MBA in 2008-10, and last 10-11 years I have been a semi-technology guy. So I worked for 3 years in finance, core finance, not at all related to technology. I worked with risk management firms, credit rating firms, and then I shifted to data science. And because I got into data science, again I learned coding. But still I am, you can say, a jugadu coder. So I'll not get into technical, but from a layman perspective, from a user of technology who does coding in his own crude way, how I see Python, it's a multi-purpose programming language, and this definition I am keeping it very focused to financial markets, because Python is very vast. There are a lot of things which can be done, but here we are looking at Python only from financial market perspective. So it helps us to provide unbiased data-driven insight. So you can derive a lot of data-driven insight, your exploratory data analysis and patterns. Like, what if I say, can you tell me what are the 10 biggest patterns of wealth creation? Can you tell me what are the 10 biggest patterns of wealth destruction? So you can use Python to leverage a lot of historical market data to identify patterns of wealth creation. Leverage could be one of the ways how wealth destruction happens. Very high working capital intensive business is one of the ways how wealth destruction happens. So only when you analyze data and you see some kind of common pattern among all the wealth creating stock, wealth destroying stock, and you create two separate clusters of wealth creation and wealth destruction, you say, okay, I have identified it. So many times what you hear a lot of fund managers telling, when you skim through the data, you'll realize same kind of insight. So Python helps you to do that. To build automated productive research. So you can build tools like your chat bots and your Q&A bots by which you can use Python. And many times, we look for answer, like let's say if I am researching on auto sector, I want to know what is the market, what is the share of revenue comes from reusable tires versus new tires through OEM. So OEM versus aftermarket. I don't know in which company, which annual report, which con call this thing has been discussed. But what if I type a question and my system skims through all the thousands of documents and gives me the most relevant answer? So these are some of the examples how you build automated productive research. To validate and benchmarking of human hypothesis. So by when there is blood on the street, should I believe in this hypothesis or not? So the best way to do is try to skim through the data and see what happened when there was a blood on the street and you purchased, and what does data says historically. Do you make money or do you lose money, or do you make money in certain situation and you lose money in certain situation? To build systematic investing and trading systems. So many times, a lot of traders you will see, they will have a very clearly defined rules for buying and selling, but the moment market fluctuates, their emotions go up and down and they do things which they don't want to do out of fear or out of greed, whatever. So many times people who are, despite being good at analysis, if they are not able to follow their emotions, sometimes it's good to give up yourself to the system so that you are totally emotionally detached. Or many times experimentation helps to identify good trading algorithms which can beat your own intuitional or gut feel based kind of trading skill, and to provide an alternate point of view on investing and trading. Like if your system or if your data driven insight is telling a very different view than what you're having, then it's time to question yourself and your assumptions and all of that. So Python in some way in financial market, it helps us to do all of these things. And how? So I'll take certain examples. So one is descriptive and exploratory. So I don't know if you can type, anybody knows what is the difference between descriptive and predictive? If you can just type quickly, descriptive and predictive, what is the difference? Okay, so descriptive is more, you go back in time and you analyze. So analyzing the historical data is descriptive, but using insights from historical data and then making a prediction about future with some reasonable set of accuracy. So there is nothing called 100% accuracy. And many times you will see when you visit YouTube, 99% accuracy algorithm and all. What is certain 99% is 99% of those algorithms are fake, because a 99% accuracy in real world is a myth. And even with a 50% accuracy, you will be able to design systems which are very profitable, because it's not only about accuracy. So I'll show you through some example, but descriptive is more historical analysis, predictive is more futuristic. So what creates wealth? By studying last 30 years of companies which created wealth, you can do a descriptive analysis. So you can create an insights dashboard which can help you to identify, and we will see some of the use cases we are going to see. So Python can help you to do descriptive exploratory insight generation. It can also help you to make predictive insight generation. So what is the probability of 10% correction? And mind you, when I tell these use cases, the idea is not to identify the exact top and exact bottom, because as I said, there is no algorithm which is 100% accurate. Algorithms have their own reasonable accuracy. The question is, for you, is it useful or not? So let's say if we have 50%, like let's say market kal upar jayega ya niche jayega. Let's say we don't know anything, so we have a 50-50% probability binary. But if there is a system which is giving you a 60% probability, it's better than 50%. And if with that 60% probability, if you are able to do little better in terms of your ROI, return on investment, then it's good. So it depends on use case to use case, whether we are having a use case for tomorrow's prediction or for next 6 month prediction or for a probability. So there is a big world called machine learning world. And in machine learning, there are different kinds of problems like classification problem, regression problem. So if you want to find what is the CAGR return of Nifty after 1 year, it's a regression problem, because you are trying to predict a continuous variable. But if you're trying to find whether after 1 year Nifty return will be positive or negative, then it's a classification problem. You are giving a binary yes or no, positive or negative. So there are different kind of machine learning techniques, and Python is also useful and helpful there. So both for descriptive as well as for predictive. Then for building automation and back testing. So you can build trading or investing algorithms. So there is a field called factor investing, systematic investing. So all these are ways. Like what if we all know when PE goes below 16, it becomes very attractive. When it goes above 24, it becomes very overvalued. So what if you create a simple investing style based on maybe 3-4 metric, like let's say PE, book value, and whenever it hits certain level, you go and buy certain amount. When it hits certain higher level, you sell certain amount. So you're just keeping your emotion aside, and I'm not telling it is right or wrong, good or bad. All I am telling is you're trying to create a system with very well defined set of rules, and you are trying to backtest it in the history, seeing how good it has worked. If it has worked really well consistently year after year, it will give you confidence that it may or may not work in future. But again, you saw, if there is one way to learn, the way to learn is from learning from the history. So Python helps to build these kind of automated algorithms for investing and trading and backtesting, and then build various kind of productivity tools like a sentiment analytics tool, Q&A chatbot. So these are some of the use cases for Python. And the way these projects are executed, so I come from finance as well as data science background. So anytime when you start solving a problem, so even if you have to use Python, you have to identify first a problem, because you have to solve something. If you don't have a problem, you can't solve it. Generating to a 30% CAGR return could be a problem, but how will you generate? So you need to convert. So maybe you want to identify a positional trading strategy to generate 30% CAGR. So that becomes your business problem statement. Then what kind of data you will need to solve? So whether you need fundamental data, which is your P&L, balance sheet, cash flow, or you need trading data, which is your maybe minute level trading or hour level trading or daily trading data or weekly trading data. And then how do you extract that data? So you need to find a source of data, you need to pull the data. Once you pull the data, you need to do some kind of insight generation, like for positional trading. So basically the question is, which are the stocks which will give me 20% return in next 3 months? So then you need to go into history and check every stock from today in next 3 months, which stock gave 20% return, and you separate those stocks, and which didn't give, separate it. Then those which gave 20% return, you have to find some common pattern, and then in new stocks you have to look for that common pattern. So you need to do some kind of analysis, like if you, I don't know how many of you trade in the market, but everybody talks about golden crossover. Everybody tells, when your closing price is greater than 20-day moving average, greater than 50-day moving average, the uptrend will start. So somebody would have done that analysis, somebody would have analyzed. People tell about oversold market, undersold, RSIs. Fundamental investors, they say buy companies which have very good return on capital, which are debt free. So somebody has done some kind of exploratory analysis to say that, okay, this is what makes money. So whatever is your use case, you need to do that kind of analysis. And then you have to build some kind of algorithm. It could be as simple as rule-based algorithm and back-tested, or it could be use of some of the machine learning techniques, and then coming with a mathematical algorithm. And then you create this output, and then if the output is good, you are happy with the algorithm, the overall accuracy, the overall consistency, then you deploy it and then you use it. So all these things become very, very important use case for Python. And everywhere you can use Python. You can use Python to collect the data, because many people feel challenged. Okay, I want to do so many things, but I don't have data, and many times the data in the market is very, very costly. So how do you get the data? What are the cheaper sources of data? And how do you collect the data for 2,000 companies for 20 years of daily level, minute level, quarterly data? How do you collect it? So whether it's collection of data, whether it's exploration of data, whether it's building algorithms, whether it's visualizing the output, whether it's deploying the algorithm, everywhere Python plays a role. And there are other tools also, but I'm highlighting Python because this session is dedicated to Python. So what I have done is I've tried to pick few use cases combining this descriptive, predictive, automation, and the stages of all this analysis. And I have tried to identify certain use cases. And also I'm giving you some of the Python packages which you must explore to know more about Python, to make best use of Python for financial market. So nothing starts with data. So first is your data collection. So these are two packages you can use for data collection. Y Finance is one package and NSE Pi is another one. NSE Pi is a India-centric package which is only for Indian market, but Y Finance is across the globe, any stock across the globe. It derives data from Yahoo Finance. And my suggestion would be go for Y Finance because it is much more richer, it is much more global, much more scalable. And we will see examples. So you can collect data using these packages and you can analyze the stock, whether you want to analyze fundamental data or information like P&L, balance sheet, or you want to analyze trade data of daily buy and sell. Once you collected the data may not be in the best format, some data might be missing, or you might need to do a little bit of analysis. So all your data cleaning, these are the packages, pandas and numpy. Anybody who's using Python, they will be aware. So whether you want to do aggregation, join, sorting, all of that you can do, cleaning you can do with these packages. So you collected the data, you cleaned the data, and then comes data analysis. So there are certain specific packages which have been created to do financial analysis using Python, and Quantstat is one of the very important package to do stock analysis using Python. So what are these packages? So just a little bit about packages. So let's say if I have to write, if I want to find whether a given year is a leap year or not. So for that we need to understand the logic of the leap year. Okay, it needs to be divided by 4 and so on. And then we need to codify that logic. Now let us say there are 1,000 people interested in finding leap year. If each of the 1,000 person writes his own code, then it's going to be waste of time for all the 1,000 people because somebody has written it. So rest of 999 people can just use it. So basically packages and functions, they are a way to use. Somebody who has solved a problem and other people, they want to solve the same problem, they don't need to write the whole code. They can simply call that function and in one line they can get the same thing done. So that is what a package does. So if somebody has created a way of analyzing a stock and you find that way as a good way, you don't need to write the whole thing. You can just use some of the functions from this package and you can get the whole thing done with very minimal effort, very few lines of code rather than writing a whole long length of code. So that is the importance of package, and that is what a package does in a layman's term. So we'll see example of this. Then comes feature engineering. Now feature engineering is something which is very popular in machine learning, but let me explain. So if you trade, many people have built their trading systems based on certain metrics. Some people have built all their trading system based on exponential moving average, maybe 20, 50, 200. Some people work on a MACD, moving average convergence indicator. So their system is built on MACD. Some people use ADX. So there are different kinds of metric and everybody use. Some people just use normal price and volume, high, mid, high, low price. But if you see this MACD, this moving average, this RSI, basically everything is derived from your basic price and volume. And then you have created features out of it, which is helping you to build a system by which you are making money. So basically you're doing a feature engineering. It's like creating features out of your raw data, which can give you insights about the problem which you are trying to solve. So in Python, for technical analysis, there are specific packages like pandas_ta, talib. These are the packages where you don't need to write codes for calculating moving average, for calculating RSI, for calculating MACD. With a simple one line of code, you can create all these information. You can create 20-day moving average, 50-day exponential, RSI, and then you can use it for your analysis and building a system or building algorithm which can help you to generate market beating returns. And then comes machine learning. If you want to do, you can build a simple descriptive rules, or you can run machine learning algorithms like regression, classification, and all. So there are Python packages to do that. Or you want to do a sentiment analytics, like you want to know, 1 year back everybody was gung-ho about IT sector, and right now IT sector is going through a phase where people are talking about now firings are going to happen and US market is in a bad shape. So how do you identify the sentiment of the market? Maybe you can collect the con call transcript. Con call is basically a quarterly interaction between management and shareholders. So maybe if you take 20 companies from IT and 20 companies from hotel, if you would have done a sentiment analysis during COVID times, you would have seen that in hotel industry there was a lot of pain and IT industry sentiments were great. And you saw the IT sector shares went like anything, and hotel sectors stock didn't perform. If you reverse it now IT sector con call will be in pain and hotel sector will be booming. So you can use a lot of these sentiment analysis tools to understand, because one person cannot go through thousands of documents, but a computer machine language programming language can go through and can analyze, and it can give you those insights. So a lot of packages are there to do that kind of analysis. So NLTK, scikit-learn, these are some of the, I'm sorry for the spelling of scikit-learn. So you can just Google scikit-learn. Scikit-learn is package for machine learning models. So you can do. Or specifically for financial markets, if you want to do a back testing of algorithm, like let us say everybody tells that buy when there's a golden crossover. A golden crossover is when your closing price becomes greater than your 20 moving average, 20 greater than 50-day moving average. So people say buy when there is a golden crossover and sell when there is a golden cross down. But how do you know if this strategy has worked in the past? What if you just looked at 10 examples, but what if 90 examples failed? So back testing is a way where you go in history and you apply that logic and you see how much money was generated. So vector BT is a package which helps you to do back testing in Python. So I have, for each stage, I have tried to give you certain packages and certain use cases like analyzing stock, analyzing market, sentiment analytics, algorithm building. So what we will do is we will go use case by use case, and for we will use each of these packages, and we will try to learn a little bit about how to do each of these analysis. All good so far? Any questions? Any questions, or we are good so far? So we'll jump to use cases.
Yes, please.
Okay.
We'll take up the questions after your session. So normally they type in the questions, take it during the Q&A.
Sure. So as I said, Y Finance is a package which helps you to provide you access for a lot of financial data. So the way to do in Python is basically, let me show you. So it's very easy. Earlier we used to install Python, but Google has made life easy. So Google has put the whole Python in cloud, and you have something called collab.research.com. I don't know how many of you use this thing Google, and when you'll go here, you will see Google has a lot of things, and one of the things, I don't know if they show it here more from, I think if you go here, just type collab.google and you'll get it. So type collab.research.google.com. Once you type this, you will get, okay, I'm just canceling because I have programs. You'll get this kind of, interface. So here you can go and you can run your Python script. So give new notebook, and you'll get this kind of screen. So you don't need to install Python, nothing required. You can just go start typing and executing your Python codes here. Okay. So like I have done it here. So you need certain packages. Packages will help you to, do quick coding and quick retrieval of information. So you can see I have installed Y Finance, I've installed Pandas T, and then you need to import these packages to use it. And I'm giving some nickname. So if I have to use pandas_ta, I don't want to type this whole thing. I just want to type ta dot and then use the function. If I have to use Yahoo Finance, I'll give yf dot and I will use this function. So I'm using Yahoo Finance package so that I can get the desired data. Let me just put it in F5 mode. Yeah. And then what I'm doing is I'm trying to download the trading data for this company infi.ns. Infi is basically Infosys and NS is for NSE. How we do it? So like whenever you want to find a script, all you need to do is, so let's say I want to know for Infosys. So go to Yahoo Finance website, finance.yahoo.com, and let's say you want to find what is the code for Infosys. So you give Infosys, and then you can see Infosys Limited. This is New York because Infosys trades on New York Stock Exchange also, but I need information from NSE. So this is the NSI, and infi.ns is the code. So this is how you get your code. So I give this code. Now download is the function under Y Finance package, and in this function I need to pass information in a specific template. So the template is which company, what is the start date, what is the end date, and what interval data we need. Do we need daily level data, or we need minute level data, or we need weekly level data? So whatever interval you will give, so I have given daily. So then it will give you all the data between this duration for Infosys, where you'll get the trading data at what every day, at what price did it open, at what price did it close, what was the high price, low price, volume. So I'll just show you a little bit here, so that because of lack of time we can't go in each of the things in detail, but I just want to show you how to execute these things at a basic level. So let me just do for only for Yahoo Finance and few more packages. There are ID interfaces also, so you can Google about Anaconda. Anaconda is an interface, so that way you can install on your own PC also, and then you can practice. So you can directly practice in cloud using Google Colab, or you can install something like Anaconda and then you can practice. So Anaconda is the ID which gives you access to different kind of programming languages, including Python. So I've installed these packages. Now I'm importing these packages. Okay, NSC Pi I didn't have, so I don't need this. Don't worry about all lot of other details. Now what we will do is we will try to download Infosys data. So you can give DF is a data frame. It's like a table where this data will be stored, and YF is for yfinance.download. Maybe I will have somewhere, I'll just copy it for the benefit of time. Let me see if I have it somewhere. Okay. So YF.download, and then my script name is infi.ns. So I give double quotes infy.ns and then my start date. So let's say I want from 2001. So 2001 0101, and end date is, let's say, till yesterday. So 2022 and maybe 08 and 2809, and interval, let's say I need this data at a daily level. So interval is equal to 1 day. When I do this, you can see it has completed. Now if I show you DF, and there will be so many rows, right? Because we have almost 20 years of data. So if you give df.shape, you see it has almost 5,400 rows. So 252 days in a year, 252 trading day in 1 year. So 5,000 means 20 years of data you have. And if you want to see this data, you can give df.head5, and you can see this is the 2001 Infosys traded at 89 rupees. And if you want to know the latest price, so right now Infosys trading somewhere around 1,400 rupees. So this is how you get your data. This is how you get your trade data. Now you can do a lot of things on this trade data. You can you can do analysis, you can do a moving average analysis and all of that. The other way is how to get a fundamental data. So you can use the same yfinance package, and you use this yf.ticker. So I'm doing the same thing for Infosys. So yf, so again, let's save it in a file data frame called infi, and yf.ticker t will be caps, TICKER, and give the same infi.ns. And then when you give dot get info, you'll get a lot of this info. So infi dot get info. So it tells you a whole lot of things, like in what kind of market, what was the market capitalization, what is the daily trading volume, which city this company is listed. So you get a lot of information, P ratio and all of that. Let's say you need balance sheet kind of data. So one way to do it is give infi. Now all your information has been saved in infi. So give infi, press dot, and then wait for some time, and you'll get so many functions. So let's say I need balance sheet data. So when you give infi.balance sheet, you can see all your balance sheet item and information is here. Of course, you need to do a lot of cleaning. You need to put in right format. You can write it to your Excel sheet or whatever. But this is how you get a fundamental and technical data. So this is one example how data collection happens using Yahoo Finance, Y Finance package. Now, let's say you have collected your data. Let's say you have done a little bit of cleaning. Let's go next. So next, let's say you want to do data analysis. So for data analysis, we have this package I told called Quantstats. So we will install this package Quantstats, and now I'll not show you, but what you need to do is you install Quantstat package, and then you import it, and then I'm just giving a proxy name QS, and then you give qs.utils.download returns for Infosys. Again, I'm doing for Infosys, and then I'm generating a full report. With this 4 line of report, what all you get is it gives you a whole history of when Infosys started trading, what is the data frame, what is the CAGR return Infosys has generated, what is the cumulative return it has generated, what is the maximum drawdown is basically what is the worst possible return from a top. So in 2000 dot-com bubble, Infosys stock corrected 83%. Like right now, you will see Nasdaq has corrected 35% from the January top, the same way. So you get so much of information, your drawdowns, your drawdown days, volatility, some statistical metric. Those who trade and build algorithm, they will be aware of some of these metric. What has been the mean monthly return, how the Infosys share price has moved, how the returns have moved. These are the drawdowns. So basically between 2000 to 2006, you see Infosys didn't make any return for 6 years because of dot-com bubble. And somebody who purchased at a peak, his 100 rupee became 17 rupees here. The future drawdowns were there. The next drawdown in 2008 crash, Infosys corrected 50%. In COVID, it corrected around 35%. You get the 5 worst drawdown periods. So these were the periods when Infosys corrected the worst. So 33% is the 5th worst correction. And this is the time-wise correction. It took 168 days to cross the same price again. Here it took almost 6-7 years. And these are those periods of drawdown. This is the monthly return chart of Infosys. This is the monthly distribution return of Infosys. This is year by year return. So you can see anybody who held Infosys for more than 1 year, out of 20 years, there were only 4 years, 1, 2, 3, 4, 5, 6 years when Infosys has given negative return. Else, almost 24 is 25 years. 18 out of 24 years, Infosys has given a positive return. So you see, with simple 4 line of code, you get so much of analysis, which you think if you are doing it manually, how much time it will, take. And even though you are not present in the market in 90s, 2000 dot-com bubble, this gives you an idea of how severe the dot-com bubble was for IT companies, how severe the 2008 recession was. So even though you are not present in the market, through data, you are virtually living in the market with few lines of code. So this is how you do analysis, and this is again just one example. Next is analyzing market. So what I have done here is this is another tool called Power BI. It's a visualization tool to create a lot of beautiful charts, but a lot of data preparation for this, like how do you calculate your return on capital, how do you calculate your debt equity. So in the background, there's a Python script which is running, and that Python script analyzes and does all the calculation for 2000 stocks for 20 years of data, and then we use that data to create these kind of dashboards which can help us to predict market. So like I want to know if return on capital has an important role to play or not in wealth creation. So what I have done is I have created different bins of return on capital employed. So these are set of companies where return on capital employed is more than 30%. Here it is between 20 to 30%, 12 to 20%, 5 to 10. Anybody knows what is return on capital employed? Basically, it's a way to find if you are generating enough returns on the capital you have deployed in the business or not. And typically, if you'll see, you will raise loans or equity, you will raise debt at a 9%, 10%, 12%. So until unless you are generating more returns, more than 12%, 13%, basically you will be sucking up capital, and that is why companies go bust. Like why your Kingfisher airline went bust or why some of the companies went bankrupt, because they took loan, and they took loan in such a business where they couldn't generate enough profit, and that enough profit was basically your return on capital, very simply said. So ideally, if your return on capital is higher than your cost of capital, then you will end up making money and slowly paying loan and you'll grow. But if your return on capital is lesser than cost of capital, a day will come when your business will sink and then you will default. So if you see this information, and this is the CAGR return, 3-year CAGR return. So you can see there is a big difference between companies whose return on capital is less than 10% versus companies more than 10%. So it tells me, yes, return on capital is very, very important, and it should be more than 12% to generate market beating return. If you buy anything less than 12%, then there are chances that your returns will be lesser, because even though overall is 9%, you will have a lot of companies which will give you negative. So you can say, okay, there is some importance of return on capital. So same way, you can take each single metric and you can say whether this metric plays any role or not. So all the background data cleaning, data preparation, data transformation work has been done in Python. But for visualizing and all, Python is not a great tool. There are better tools like Power BI. This is a Power BI tool. So I do a lot of visualization in Power BI or Tableau. But for all the data preparation work, these are not the best tools. So all the data preparation happens through Python scripting. So this is one way. How do you analyze, overall markets? Or there is another example. Yeah. So there is another way. We spoke about catching a falling knife. So when you catch a falling knife, when all these stocks are falling like 9 pins, means a lot of companies are making low. So here is a metric called 52-week high and 52-week low, and this ratio tells what percentage of companies are making 52-week high, what percentage of companies are making 52-week low. And this is simply buying small cap index fund. So if you simply buy small cap index fund, and this is the bi-weekly data, 15 days data, then your 12-month return, if you buy and sell after 12 months, your mean return is 14.6%. You will know market in general has given 12 to 15% return. But what if you buy when more and more companies are making 52-week low? So I change this, and now I am buying only in those months when more than 18% of the small cap companies have met 52-week low. Then my mean return increases from 14% to 18%. So just by doing a one univariate analysis, I was able to improve my return by 4%. And these were the months when this happened. So, those who are there in the market from last 10, 15 years, 2011 to 2012 13 was not a great market. Market was depressed and it gave a lot of opportunities. This was a time when you got this Brexit happened and market crashed. Then 2018-19 was not good for small cap. It topped in 2017 December and market gave many opportunities. This was COVID time. So, you got to pick very interesting 56 month out of 288 months when more than 18% companies met 52-week low. And rather than making 15%, 14% generic return, you would have made 18% return. So this is how you analyze market. And again, in the back end, all these calculations, scripting work has been done in Python. This is a tool to play, which is more a visualization tool. So this is how Python helps us to, analyze markets. Now, next we'll go into algorithm and backtesting. So Vector BT is a package which helps you to build algorithms. So here what I have done is I'm trying to build a very simple algorithm of golden cross. So we saw that pandas_TA was a package for technical analysis. So we did import pandas_TA as TA, and this TA becomes my proxy name. And in TA there is a function called SMA. Basically this is a function to calculate simple moving average. A simple moving average is nothing but the average value of last n incidences. So I'm trying to find the simple moving average of 50 days. So it will calculate. When you do this function, what it does, it creates a column called SMA 50, which is the moving average of closing price of last 50 days, which is 1870, and this is how it is moving. And this 200 will create a moving average of 200. So the logic I am writing is, whenever the 50-day moving average is greater than 200-day moving average, I'm doing a buy, and whenever it goes less, I'm doing a sell. Very simple, just to test. And then this is my entry and exit. So whenever you can see your 50-day moving average is less than 200-day, so your entry is false, false, false. and the time will come when the entry will become true. So basically, we build these algorithms just to test, whether this logic works or not, how much return we get with this kind of logic. So again, it needs little bit of coding effort. Here I have done that kind of coding effort. But finally, when you do all this coding, you do all this back testing, you generate your final output, you buy or sell logic, then how do you test whether it's a good algorithm or bad algorithm? So as I said, many people, they talk only about accuracy, but algorithms accuracy is just one dimension. There are a lot of other things, and those other things are, so see here I created this, and then I'm using this vector BT for backtesting, and I'm telling, give my portfolio details for this kind of backtested logic where I am buying based on this, and this is the algorithm output, which tells this is the start date, this is the end date, this is the benchmark return, this is the total fee paid, this is the total number of trades. Out of these trades, how many trades were positive? 40% of the trades were positive trades. This were negative trades. When my trades were positive, what is the return I made? When the trades were negative, how much did I lose? Then some statistical metric, and this is how your final output looks like. So this is your close. This is a stock by stock. I have built this logic. Buy trigger means the buy has been triggered, sell has been triggered. This is my entry, this is my exit, this is the return I have met, and this is my final dashboard. So how many transactions happened? So totally 471 trades happened. 60% of the trades were positive. When I made positive trade, my average return was 32%. When I made negative trade, my average loss was -6%. So basically, there is a 5:1 risk reward. When I'm winning, I'm making 30%. When I'm losing only 6%. So out of, if I make one successful trade, I am able to cope up with loss of 5 trades. So accuracy is just 60%, but this is helping me. Think about another algorithm where your accuracy is 90%, but win return is 10% and loss return is -15%. Then what is the use of that accuracy? So it depends. The good algorithm is a combination of win ratio, your average win return, your average loss return, how much time it is taking to hold to your winners, how much time it is taking to get rid of your losers. So accuracy is just one dimension, because ultimately in a given time, how much return you made with what kind of volatility, and then how consistent the algorithm is. What if most of your returns were made in only 2 years? Will you rely on that algorithm? So you have to see the consistency. What is your win rate? How are you winning year after year after year? What is your volatility? What is your drawdown? So using Python, you can do all of these things. So again, all the data calculation algorithm, everything was built in Python. Finally, the whole data was taken into Excel in this format, and then in Excel, a dashboard has been created in this format. So this is how you do algorithm building and backtesting in Python using some of these formats. The last is the automation and productivity tool. So what we have done here is, so conference call transcript is an important document. Every quarter, not all companies, but out of 2,700 plus companies, every quarter they will conduct a conference call where all the analysts and the investors, they can come, and the CEOs and the CXOs, they will come, and then the analysts and investors can ask various questions related to business performance and get a sense of business, and accordingly they will take their investing decision. So there are times when the companies are very hot. Everybody wants to, buy that stock. Some sectors are hot, like in 2020, pharma was hot. 2021, nobody's talking about pharma. 21, IT was hot. Right now, IT is going through pain. So sometimes understanding the sentiment of these con calls can give a lot of interesting insights. The simplest insight could be, when the stock is doing very well, lot of analysts are covering. You will see the con calls going in 25, 30 pages. And when the stock is beaten down, everybody is frustrated, people have sold the stock, nobody is interested in buying, the same con call will go in 12, 13 pages. So even having a simple count of con call pages, trajectory, and how the prices move, that can sometimes throw insight. Or you do a data aggregation at a sector level, or sometimes just understanding what are the positive and negative words being spoken in the con call tells a lot about the kind of situation the company is. So you can do a lot of these things. Affine is a package in Python by which you can find the sentiment score. A sentiment score is nothing but it's a kind of weighted aggregated score of all the positive and negative words being spoken. So every year has 4 quarters. So basically what you see is for 24 quarters, how the sentiment has moved and how the stock prices moved. So you can see when the sentiment went down, the price also was down. And then when the prices started moving up, the sentiment is also improving. These are some of the positive words, negative words. So you can build tools to, speed up your research process to get some kind of insight out of unstructured data as, complex as a, a 20-page text conversation. So imagine if you do same thing on somebody's interview, some video interview. So this is one way how you can leverage sentiment analysis and still derive the insights to take decisions using machine learning and Python. So again, a lot of this work, again, the whole background algorithm building, text extraction from the PDF file, this generation, all the things were done in Python. And once the final output was created in terms of the scores, the keywords, again, we put it in a Power BI visualization dashboard, and then we generated these insights. So these were some of the 5-6 use cases, right, from your data capturing till model implementation, how each and every stage you use Python. So a little bit about scientific investing. So we have a website called learn.scientificinvesting.in, and as Nitish said, so I was working with EY till last year, but I have taken a break. One of the idea was to convert all the understanding knowledge into some kind of consumable content. Also, I wanted to build some of my own systems where I needed to dedicate time. So with that objective, I have created scientificinvesting.in. You have courses related to fundamentals, technicals, quants, and all the things. Also, I run a YouTube channel with Scientific Investing name, where I cover views on market, fundamental analysis, stock analysis, quants analysis, some of the things which I discussed in Python. You have 2-3 session videos on Python. So explore it and see if you find it useful. So that's what I do at Scientific Investing. So with this, I end the presentation and we open the floor for questions.
Thanks, Saurabh. Thank you so much. It was a very insightful session. And before we go to the Q&A, maybe we'll give you it was a long session, so we'll give you a 5 minutes breather. And in the meantime, we will just like briefly see what we do at IIQF, and then we will take up the questions. Hope that is fine with everyone. Right. So before we go into the Q&A, as I mentioned, let's give sort of 4 or 5 minutes of breather. It has been a long session. He has been very passionately speaking about the topics. But before going into the Q&A, just like to introduce the participants a little bit about our institute and the work that we are doing. So most of you may already know, I represent Indian Institute of Quantitative Finance. And this is an institute which is the first quant institute in India dedicated to education and training in the field of quantitative finance, financial engineering, risk management, quantitative algorithmic trading, artificial intelligence, and machine learning. We were founded by pioneers in India and top experts from the field of financial risk management, financial engineering, and investment banking. Our institute has always focused on promoting education and training in the field of financial engineering, quantitative finance, risk management, investment banking, algorithmic trading, derivative products, artificial intelligence, machine learning, and several other areas of modern finance for more than a decade. So for people who are interested in learning in deep about these fields, related to the quant, risk management, financial engineering, algorithmic trading. So we have very comprehensive courses where we teach end-to-end very comprehensively about these fields, and like we prepare you and make you ready for this kind of jobs as well. So those who are interested in learning deeper into algorithmic trading, we have a couple of courses. There's a 6-month course called Postgraduate Program in Algorithmic Trading. This is a course where we teach very comprehensively all aspects of algorithmic trading using technical analysis, machine learning, and quantitative models. Then we have a shorter version of like the algorithmic trading course. It's called Certificate Program in Algorithmic Trading. That's like a 3-month course that teaches end-to-end all aspects of algorithmic trading using only technical analysis. Now, for people who want to make a deeper career into like financial engineering or quantitative finance and those kind of analytics, we have a couple of courses. There's a course called Certificate Program in Financial Engineering, which is a 7-month course, a very comprehensive course, which deeply covers both theory and practical mathematical modeling for derivative valuation and risk management. Then we have a course called Certificate Program in Quantitative Finance and Risk Management, a 6-month course. And that's a comprehensive course which teaches and goes deep into both theory and practical modeling for derivative valuation and risk analytics. For those who want to start small, since Python is like the base tool or the language that we use for doing all this in all these courses rather, and in this Python, since as Saurav has mentioned, why Python is so important in our field. So those who want to start small by learning only the basics of Python and how we use the basics of Python, how you use Python in finance, the language as such, then we have a small module on Python programming for finance, which you can join and start, and then of course you can progress to the other courses. So all the courses that you see, these are all weekend live interactive lecture-based sessions. So I mean, very suitable for people to do along with their job, or if you're a student, you can do along with your main course that you are pursuing, right? And the Python basic module is like a pre-recorded self-paced course, but the other courses are through live and interactive sessions on the weekends. So over the last more than 12 years of our existence, a lot of professionals of students have done our programs, and some of them have been, have been kind enough to share their experiences and how they have used this courses to make their mark in the industry. I mean, not to maybe like again drumbeat about our courses, but it's like our orientation always has been to promote the quant finance field in India. That's like where we come from. We were formed to promote the quant finance industry and the field in India. So from that aspect, I mean, for those who are not aware how to use the skills to make a mark in the industry, just wanted to showcase few of our students who have use these courses to actually establish themselves in the industry. So a lot of them have gone on to do these courses. Some of them have been very kind enough to share their experiences. You can go to our website and like check up the courses, the experiences that the students have shared, and you'll have an idea about how you can also use these courses in case you are interested in making a mark in the industry, or if you are already part of the industry, how you can go into the deeper domain side. Right. So, I mean, for these courses, the target jobs actually are like to work as a financial consultant or a domain expert on lead quant teams of international banks, top hedge funds, or Fortune 500 companies, hedge funds like Renaissance Technology, DSO, Citadel kind of companies, or like international investment banks like Goldman Sachs, Morgan Stanley, Deutsche Bank, and commercial banks like JP Morgan, Citigroup, Nomura, etc. You can work with even consulting firms like EY, Deloitte, PwC, and all these guys, and of course the IT companies as well, because a lot of the IT companies also supports the banking industry. So companies like Accenture, Cognizant, TCS, and all, they also have a lot of requirement for people having this kind of quant analytics and risk management, algorithmic trading, and all this kind of background. Right. So yeah, these are the kind of profiles which you can target by doing this courses. You can go into quantitative research and analysis. You can be building quantitative and analytical softwares, or you can be part of the model validation team, the modeling team. We are building the various quant models. You can be part of the portfolio management team, portfolio analytics, and of course, you can go into the different financial risk management areas like market risk, credit risk, operational risk, liquidity risk. You can be part of derivative structuring teams, quant trading, high frequency trading teams, and of course, other kinds of algorithmic trading and derivative trading teams as well. Right. So And this is a very small list of people or companies which we have worked with. I mean, as consultants, as trainers. I mean, a lot of the companies do recruit and from our courses as well. Right? So there has been a very strong industry association that we have had over the last 12 years, because we anyway come from the industry. So we have a good connect. And then, of course, we have been associating ourselves with like educational institutes as well, where we conduct courses. I mean, institutes like IIT Bombay, BITS, Pilani, and ET, to name a few, where we have worked with. So if any one of you wants to know more in detail about us, our courses, you can visit our website at www.iqf.org, or you can call us or email us on this number. So with that, we will go back to the session and we'll start with the Q&A. Just like let me make change the presenter. Allow me a moment. Right. So let's go to the question. Saurabh, we will take up the questions one by one. So first, let's start with Nikhil's question. Nikhil's, though you have discussed in length about how Python can be used in algorithmic trading and all these areas, but like still, if you wish to add something, Nikhil has a question: how Python help to boost career in finance sector?
Yeah, so if we look at, I hope I'm audible. Nitish, am I audible?
Yeah. We can hear you, please.
Yeah. So if you look at the recent hirings and all, whichever is happening, especially on the US side, whether you talk of Citibank or Goldman Sachs, earlier, it was a pure trader profile, but right now, if you see, 20% of the profiles are being filled by coders, developers. So that is how, technology is changing the hiring pattern. Even in India, when you see years back, you didn't have any kind of quants fund. But today, if you see each of the fund house, they're having some kind of quant fund. I think DSP, their quants fund is almost 1,500 crore in last 1-2 years. So slowly you're seeing the prominence of technology-driven funds, whether it's AMC industry, whether it's hedge fund industry. Some of the companies which Nitish mentioned, they are multi-billion AUM companies, which work only through technologists and data scientists. Like I heard Renaissance Fund, they don't have financial guys. They have only mathematicians and physicians, those who can code. So that is how technology is changing the world because of multiple reasons. One other key reason is cost, because everybody is into cost control mode. So how you can get things done with 10 people, which you are doing with 50 people, and technology is the answer. So a lot of these things are creating a world where technology is more and more required, and hence the job profiles of some of these companies are changing, and that is where having skills like Python and machine learning and all of this is very helpful.
Absolutely. So next question is from Amish, and Amish says that he do not have a coding background, but definitely since he is in, so it is, that question is a little incomplete, but if I understand properly, he wants to maybe know that if he's not from a coding background, and like again, he wants to start with where to begin as a non-programmer, and like again, if he's interested in like using Python for his work in finance.
Yeah, so I think Nitish, you will be the best person to guide, but my suggestion would be start with some basic course on Python. I think Nitish suggested you have some pre-recorded courses on Python. Also, you explore MOOC platforms like Udemy, Coursera. You get enough courses on Python. On YouTube also, I think there are channels like, I think, Code Factory or something. You have courses on 8-hour courses. So you can start with some of the basic courses. The Collab, which I showed you, in Collab itself, you have learning modules. So it's all about picking one good course, picking one good book, and then it's all about practice. You just keep practicing for a period of time, you learn.
Yeah, absolutely right. So as Saurabh mentioned, yeah, I mean, so there are a lot of finance professionals, Amish, and this is not something typical of you. Essentially, this is something which is true for most finance professionals, because a lot of us, when we were starting out in the finance industry, we never thought that I mean, programming will be so much used in finance. And again, as a naturally, finance courses does not teach you programming, right? So it's never too late. And given the fact that the industry is changing, again, the way to go is to keep on learning, because things are quite fast paced nowadays. Those era is gone, like where you get one degree and then like again you use that degree to make your whole career, right? So nowadays things change so fast, so you have to keep on learning. And like again, there would be new tools that actually will be used. I mean, it will keep on coming, right? So the idea is to keep on learning whatever new tools come up if you want to stay relevant in the industry. And as Saurav has explained in detail, right, that then programming Python, if somebody wants to really work into deep analytics in trading or valuations or risk management even, I mean, not only in trading, then I mean, this kind of programming skills or tools are actually very, very relevant, and should be learned at some point of time. The sooner the better, right? So again, if you're a finance professional and if you want to make a career in analytics, trading and all that, then Python currently is the tool that is very useful to learn. But you never know of the future. But for the time being, you start with this. And if you do not have a coding background, as Saurav says, there are a lot of courses to start learning. As I said, I mean, we also have a course on basics of Python you can start with. In fact, maybe, I mean, there are a lot of good courses, but maybe the advantage of doing it through the IAQF Python basic courses, because that's like a course which is very targeted to finance, right? So when you do Python from general courses, those are general programming courses, and it's somebody starting out, it's like maybe a good idea to do a targeted start and learn what are the things in Python that you need to use straight away in finance. And of course, later on, if needed, you can expand your horizon. But it's like you may start with this Python course, or again, as I sort of mentioned, there are hundreds of courses of Python available. Select a good course and start with. But if you are interested in this kind of fields, then at some point of time, do start learning Python as soon as possible. Okay, let's move to the next question. Next question is from Rishikesh, and he mentions, is there a Python program that can give a list of stocks that breaks moving average, example 50 days or 100 days moving average?
You can
would
do
you like to?
that with simple 10-20 lines of code. I'm not aware of Python program, but there is a tool called charting. So I
Right.
don't know how many you have worked on SQL. So SQL works like a very English-like language. Select name from table. So it's a very English kind of intuitive. Same way when you go in charting, they are created in such a way that closing price greater than EMA 50. So you can write a very simple, intuitive English-like rules, and then you can create your scanners. So if you have used screener.in for fundamental, how you build fundamental scanners, in charting you can build these kind of technical scanners very easily.
Correct. Right. So moving to the next question. Udayan says that Y Finance package has short-term data point. Does it have short-term data points hourly 15 minutes?
Yeah, it has. So that interval you can set, I think 1 minute, 5 minute, 1 hour. So when you go through help, just check help Y Finance package, and you'll get all the intervals. I think right from minute till 3 months you can create the intervals.
Right. Right. So Deepak asks, are this package free or paid? The Python packages, of course. I mean, yeah, I mean, you may answer that question as well briefly.
All these packages are free, but yeah, there is no accountability in terms of the accuracy, and also that is something we need to be a little bit aware when we are using open source stuff.
Correct. Okay. Priyanks has asked, is learning Python too difficult for marketing professionals? Can I manage it with 2 hours per day with a full-time job? Okay, just like briefly, I'll add to what I said, maybe like, and then we'll move on to the next question. So, Priyan's 2 hours per day is in fact like a very good time for any professional. It's like, I mean, it's more about, I mean, it's not about you being a marketing professional or a finance professional. Anybody can learn this as long as they put a serious effort. And I mean, the trick is to actually do it slowly and steadily over a period of time. Because when you start with programming as a non-programmer, the initial period is the most difficult part, the hiccup. And then once you get used to it, again, it slowly starts actually building, and again, you will slowly make more progress. So, I mean, the more the number of hours you can dedicate, of course, the best. But even a 15-20 minutes daily practice, initially half an hour, whatever you can put in, but it should be slow and steady and regular. I mean, things that you should be doing, right? So yes, please go ahead and start 2 hours if you can do it. That's like very, very good time.
I'll just add my experience.
Please.
So
Yes, sure.
I went for MBA in 2008, and 2 years of MBA, 3 years of core finance. So 2008 to 13, I didn't touch coding except little bit of R we had in one of our finance lectures, and we were wondering, we have come to do MBA and again we have gone back to coding. So that was the mindset. If we are doing MBA, no coding. But after 5 years, again I started coding, and 5 years like literally no coding. So I think it all depends on interest. If you have interest, you will learn it and you will find time and you'll do it. And when I started in 2013, that time R was very, very popular. So even like when I jumped to data science, till 2017, not many were talking about Python. Bulk of the work was being done in R. And then there was a massive shift from R to Python, which happened between 17 to 19. So for me also, there is like, and I don't come from a software engineering background. So first learn R and then again migrate from R to Python. And you reach a certain stage where you don't code on a daily level because you do more QC work, but still you have to learn because you have to do things on your own for your own personal stuff. So it all depends, and things will keep on changing. As Nitish said, today it is Python, tomorrow it will be something else. Once you understand the framework and the basic, building blocks, then it becomes easier, and then it is all about your interest and if you're able to derive value out of it.
Absolutely right. Absolutely right. So it's more about your interest. If you have the interest, I mean, nowadays there is no dearth of resources to learn. Right. So next question is from Atharv, and Atharv has asked, like, I'm taking admission for MBA Finance this year, but am I supposed to do something along with my master's degree? I'm confused. Should I go for the traditional finance, which includes CMA, SECA, CPA, etc., or should I go for modern finance, finance plus technology, which will include Python and all other coding languages and CFA, etc.? Okay. So that will require a lot of explanations, Atharva. Saurav, if you wish to add some, I mean, throw some light on that, or like, I mean, maybe I'll add on to that.
My suggestion would be first explore what all is there, because first from MBA there is finance, supply chain. So now you are good, you have decided finance. But in finance, you have to just explore different profile, do as many projects as you can do, and do different kind of projects. Do projects related to equity research, do projects related to corporate finance, credit lending. That will expose you to what are the different kinds of jobs which are there, and every job will have its own pros and cons. Like, a banker job has its own challenges, a credit analyst has its own, good things, bad things, or a technology driven job where you're trying to learn finance, or you want to go into FRM or CFA. So there are 10-12 different ways. Each has its own charm, or own good, own bad. Investment banking is very fashionable, but it comes with its own side of work pressure, 15 hours a day. So try to explore as many as different work profiles, see what aligns with you behaviorally, financially, peace wise, happiness wise, and then try to go deeper in that field. But explore everything. I think next 2 years you should spend time on exploring all these things.
Very true, very true. Just to add to what Saurav has said, yeah, I mean, explore, and then if you ask somebody who is very smart and have already explored the different aspects, then I mean, what you want to do along with your MBA, yeah, I mean, a lot of people I mean, nowadays they do a lot of stuff along with their degree programs, right? So what you should be doing is totally about your choice. But just maybe a little bit of a personal suggestion, since you are already doing a finance course, right? So maybe you like to expand your horizon. I mean, doing again another finance course along with it may or may not be that useful. Like again, CMA and ACCA and all that is like CPA and all. That's like pure like accounting kind of stuff. I mean, it's not finance. It is more about accounting. So, I mean, if you have an interest into going into deeper accounting profiles along with your MBA, then go for those kind of courses. If you have an interest to go for like again the investment finance side, then CFA or FRM, and these are kind of better courses. Or I mean, but like again, just to add, again, these are all general finance courses. You're already doing another general finance course. Of course, this all adds to your profile. There's no doubt about it. Any international certificate, it always is an add-on. It definitely improves your profile. But since like most MBA courses will not teach anything about the finance plus technology combination kind of things, right? So since technology has become so much important, maybe you can think of along with your MBA, in case you have to do something, do something or learn something which integrates the technology side to finance, right? I mean, in case you really have to do something. So that can be a suggestion, but it all depends on your choice. If you are somebody who wants to stick to the pure finance side, don't want to go into technology and all, then go for CFA. If you want to go into the accounting side, go for this others accounting courses that you have mentioned. But my personal suggestion, since MBA finance will anyway cover the general theories of finance, so maybe to expand the horizon, do something, a course or something which actually teaches that technology side as well. More so because technology is like a very integral part of the advanced financial analytics industry nowadays, right? So that's like just my additional thoughts on that. So the next question is from Parag, and he says that, sir, can you explain the market breadth analyzer Simba part? Would you like to take that question, Saurav?
Which mark? Okay. Regarding the tool, which I demoed as one of the use cases.
Yes. So he wants like a recap probably on that. So he wants to know something on that.
Yeah. So
The
basically,
market breadth analyzer.
yeah. So there are different things you can do. There are people who are bottom-up investors who don't care about where the market is going. All they care about the 15 stocks which they have identified and at what price they should buy and sell. But there are investors who go by, who are more top down, because see, if the broader market goes down, the chances of stocks to go up becomes difficult. So first is your global market, then is your Indian market, then is your sector, and then is your stock. If Nifty itself is falling, if the small cap index itself is falling, it is falling because more and more sectors are going down, and that is what the Nifty represents or the sector represents. And if the sector is
Correct.
going down, then the stock. So the probability to make money in stock becomes more and more difficult if the broader market is in reverse direction. So there are a lot of investors who give importance to this kind of top-down approach, especially for a trader, because a trader has to make money in a small span of time. The long-term trend, the medium-term trend, the short-term trend, your sectoral trend, your market trend, everything needs to be in favor. So in trading, it is very important when not to trade rather than always 12 months trading, because it's all about hitting at the right time. So it becomes very important to get a sense of where the market is. In 2018-19, the stocks were very, very attractive, but Nifty did well, but the small cap stocks didn't do well because the small cap index was in a very different direction. So based on my experience, I realized that it is important to check the breadth of the market, and big money is made when you get both value and momentum. So there are times when you get only value, there are times you get only momentum, and there are times when both value and momentum they are in place, and that is where you make best money. So all these tools which are to get the market breadth, just to analyze in terms of is there value in the market, is there momentum in the market, is the small cap index doing well, is the large cap index doing well, is auto sector doing well, that sector doing well. So with that intent, I created that tool which you saw. So I showed you a very small example of taking a small cap index, because, and I took a very one specific use case showing you whether buying in pain periods helps or not, because there is a mentality which people have said, and especially in these kind of bull market when there is too much of importance on trading. I am both trader as well as investor, but the behavior I have seen is people don't understand that money is long term investing. Money is made by buying cheap and selling it costly. But The notion which is set is you have to buy costly and you have to sell costlier. That works, but that works in momentum investing. That doesn't work in value investing. So that is why that breadth which I showed in terms of 52-week high-low, just to show you example that if you are buying when there's too much of pessimism and then you hold it at least for a year, that also creates good money. So that was the purpose of that tool, and the idea is to cover how in terms of value and momentum each of the different pockets of market, by index, by market cap, by sector, they're doing.
Correct. Right, sure. So next question is from Zingy, and says that, like, could you please describe some use cases of machine learning in alternative investments? Would you like to answer that question?
I mean, I don't know how you define alternative investments, but on a generic level, see, the use of machine learning is basically to predict something. Now you have to identify a use case, and any investment, the simple use case starts with making money, but you have to quantify your use case. So few things I can think of is, let us say, will gold give more than 15% return in next 3 years? See, I'm being very specific. I'm defining a criteria 15% and I'm defining a timeline next 3 years. Now, you need to convert this problem into a machine learning problem statement, because a machine learning, your normal problem will be always about return, but in machine learning, you have to make it, whether it's a recommendation problem, whether it's a classification problem, whether it's a regression problem, whether it's a basket analysis a priori we call. So there are 6-7 different kind of techniques, or you are solving a clustering problem. So you start with a business problem which is regarding investment, but you need to convert into an analytical problem, machine learning problem, which is whether whether, or the other machine learning problem could be, if you have 5 different alternate investment options, which is the best investment option for next 1 year. Now you have 5 options, so it becomes a multi-classification problem. So you have option 1, 2, 3, 4, 5, and then you run your algorithms, you generate probability for each of the 5. So the overall problem statement remains same, some investment decision making, but when you think in terms of machine learning, you convert more from a machine learning technique perspective, whether you are creating a binary classification, you are creating a multi-classification, you are creating a regression, you quantify everything, you quantify your return, you quantify your timeline, and then once you do that, then you will prepare data accordingly and then you will solve it. So this is how you do it.
Right. Yes, thank you so much for that. So the next question is from Rishabh, and Rishabh says Python is quite diverse. So which parts of Python are essential for quant finance, pandas, numpy, etc.?
Yeah, so I gave you 10 packages. So see, your data, there are certain packages dedicated for the work, like for your data collection, for your data analysis, for your back testing. And then there are certain generic packages which will be valid, like your pandas and numpy, your date packages, all of that. That will be valid any kind of data analysis you do. If you want to do your visualization, whether it's financial data or non-financial, your SNS package, your matplotlib and all that will be, truly valuable. So you have a generic set of packages for analysis and visualization, which I listed, and then you have these specific set of packages for financial market analysis. So these are the combination of 2 set of packages you should look for.
Sure. Okay, so the next few questions are like probably, and I quickly take on those. So what is the duration of Python for Finance from Deepak? Deepak, Python for Finance is like the course, as I mentioned, it's like a self-paced course. So I mean, depending on your background, it might take between 1 month to 3 month time if you are doing like daily practice of like 30 minutes to 1 hour. Okay, so it's not about the number of hours in the course, because programming courses are not learned by just viewing the number of hours of lecture. So it is about going through it and then keep on practicing, right? So it's not about number of hours, it's about the your background. So if you have a programming coding background, you might learn in even 2 weeks to 4 weeks time as well. If you do not have a coding background, then it might take maybe 2 months to 3 months time to have a hang of the basics of Python, right? Next question is from Vitesh. Vitesh says, do we need to have technical background or coding experience to use Python? Vitesh, see, the thing is, if you have a background, in coding already, as I said, it's like easier to learn a different language. It's more about, as Saurav has mentioned, once you learn the basics, logic building and all this kind of things in any programming language, if you want to transfer to another language, it is more about just learning the syntax. So if you have a background, it's definitely easier, but that does not mean that a non-programmer cannot learn. Particularly we see nowadays, this is a recent development. Earlier there used to be a very strong segregation between fields. So a IT guy used to be an IT guy, a finance guy used to be a finance guy. So we rarely saw people having cross expertise in like multiple domains. But in the last 5, 7 years, 10 years, like we have seen that like people have started getting cross domain expertise, because like the nature of our job has changed, right? So as I have mentioned earlier, if you do not have a programming background, it's fine. But a lot of people we have seen, particularly with the I mean, nowadays when we saw a lot of like data science and machine learning courses, I mean, there we did not have ready-made resources in this kind of field. These are new fields. So a lot of people from different kind of background, they learn programming, they learn machine learning, and learn quantitative analytics, even though they didn't have any prior programming background. So it's all about your interest. If you are really interested in learning about all these things, yes, programming is something which you have to learn. And maybe, as I said, currently Python is the hottest tool that is used. So good thing about Python is, as Saurabh mentioned, there are a lot of libraries, right? So you may not have to build everything from scratch, and the syntax is also relatively easier compared to legacy languages. So I mean, it's a good language to start with if you are from a non-programming background. So yeah, that's like the answer to it. So I mean, if you have a technical background, learning Python definitely would become easier or quicker. If you do not have a technical background, the learning will be longer. But nonetheless, there are a lot of people from non-programming background who nowadays learn Python or other programming languages. So yeah, I mean, I am sure you should be able to do as well. Okay, next question is, can we get this presentation or recording of the session? Okay, I mean, presentation materials, of course, we will be sharing with all of you participants. Recording also, for a limited period of time, you will have a secured access where you can view the recording a few times. Okay, so we'll make that available. Next question is from Santosh Kumar, and he says, trader and technical analysis follower aspirants, do we hope this career can be destination for them to work for investment banking? A little question which is not like very well framed, but I'll repeat the question and see if you want to add some light on that. So he says that trader and technical analysis follower aspirants. So he's a technical analysis and trader aspirant. Do we hope this career can be destination for them to work or investment banking? So probably, if I can get the question to some extent, what he means is like, does trading or technical analysis knowledge help somebody reach an investment banking profile?
My view, investment banking is a very different field. I mean, trading and investment banking, they're two different fields. If you're a trader,
Correct.
then you can do your CMT charter and then look for a trader in a trading desk. You can look for a position. Whereas investment banking is more fundamental oriented. Your P&L balance sheet, your M&A, emergence, acquisitions, and all of that. They're two different things.
Right. So the next question actually is a little related from Uday, and she says that Python for financial modeling and do we use Python for financial modeling and valuation of companies? So yeah, I mean, can this be combined? So there actually, there's a learning Python. Does it help in like valuations and all that? Like, that's the question.
So see, these are tools. How we use it is up to us and our ability to innovate it. So like the sentiment analytics example, which I gave you just because I wanted you to think through different sources of data, because when we think of data, either we think of P&L balance sheet or we think of trade data. So I wanted to give you one additional data point, which usually you will not think because it's structured, unstructured data, but still there could be use cases. So it all depends on how you think about it. Now, when it comes to valuation, the biggest question comes is what drives valuation, because we think that only P&L balance sheet and earnings drive valuation. But if only earnings drive valuation, why some shares go 500% up in 6 months and then they come down 300%? So it's a very, very deep question. My answer is there are a lot of interesting things which could be derived out of it, not only in terms of valuing, but how to think about valuation, how to think about drivers of valuation, how to think about drivers of valuation from time frame perspective, a valuation in a 6-month time frame versus a valuation in a 10-year time frame. So you can get a lot of different insights, but ultimately it depends on how you think and how you innovate around it.
True. Absolutely. Okay, so the next question is, I hope you are okay with taking like 2-3 more questions. I mean, there are like few more questions. So is it okay, Saurabh?
Yeah. Just coming back to previous problem, like one use case I can give you. If you think in
Sure.
terms of regression, so your P is a very common, valuation metric which is being used. First, those who are fundamental practitioners, they will know that P is not something you can use for all the cases. There are very specific scenarios when you should use P. Can you use Python and machine learning to identify the scenarios where P will work, whether P will not work? What drives P? Does return on capital drive P? Does growth drive P? Does debt equity drive P? So can you create a regression equation where you can have P as your Y variable and these factors as your predictors, and then assign a weightage that in a valuation this is how you should weightage? Or will it depend on the sector also? So can your sector also become predictor? So I'm just giving you thoughts. These are the kind of use cases you can create around valuation and still extract some value out of Python or machine learning, just to take a call whether technology can be used in valuation or not.
Right. Right. So the next question is from Udayan. Okay, so it's about our course. So Udayan, about our courses, of course, we can discuss at length, but maybe one-on-one. But here, just to brief you, his question is, Udayan works in Citibank in a risk modeling credit risk team, and he wants to update himself and get more knowledge about new developments in risk modeling. What course is suitable from IQF courses? So then for your requirement, you may look at one of our course called Certificate Program in Quantitative Finance and Risk Management, which goes very deep into both theory plus the practical modeling for both the valuations, derivative valuation, as well as the risk analytics side. It's a 6-month course, and if you allow, we will have a one-to-one discussion in detail regarding that's where we can explain the course in detail, and then you can see whether that can be useful for your requirement. But yeah, I mean, whatever you have put forth, that's the course you may look at. We'll have a more detailed discussion. We'll give you a call and then we'll discuss in detail about that. The next question is from Dinesh. Any internship finance analytic program in IQF? Dinesh, more than internship, actually, we are more happy to help with job support at the end of our courses. So yes, but like I said, that all the courses that we have, again, at the end of the courses, you would be getting capstone project assignments. So where you actually get to build real life financial models for valuations of like current derivative, risk management, machine learning, developing algorithmic trading strategies, depending on which course you are doing. So it gives you a practical modeling exposure during your project itself. But no, we do not have a formal internship associations as of now. But yes, and for such people who do successfully complete our courses, we definitely would be glad to support with by connecting you to the right companies in the job scenario. Okay, so Tanya says, I am from a science background, MSc in statistics. I also have familiarity with Python. My question is, how do I know and start to learn about finance? There are a lot of ways you can do it, but the quickest, I mean, just for the sake of repeating and not to promote our courses as such, there is not the intention. But yes, our courses are actually in a very well organized way. You can get introduced to different analytical areas in finance. You can look at 2-3 alternatives: certificate program in financial engineering, certificate program in quantitative finance and risk management, or if you are specifically interested in trading, then you can look at the postgraduate program in algorithmic trading. Maybe we'll have a one-to-one discussion and then guide you the courses that we do, and maybe then you can see if those are useful to you or not. Okay, Vaivev has asked a question, which is he had asked, like, ARIMA model will help. I think the question is not complete, Vaibhav. So if you can actually elaborate your question a little bit more, Vaibhav, if you can hear me.
I think his question on time series.
We'll take up that question again.
I think his
Okay.
question on.
So if you understood, please.
So Arima is one of the forecasting techniques, but see, these are very, what I say, there are certain techniques which are more textbook. It might work in certain industry, it may not work in certain industry. The way Arima is used, basically it is used to forecast something. So like tomorrow, whether it will rain or not. So if you want to do a rain forecasting, how much it is going to rain tomorrow, and then you find a value and then you say whether it's going to rain or not. My sense is in markets there are better ways to structure the problem rather than trying to forecast a specific value. So there are much better use cases than using Arima in the stock market, but you will see a lot of academic papers and all where Arima is used. But my view is there are better ways to structure a problem and there are much better techniques to use. The domain knowledge is very, very important in stock market. Like your technical analysis knowledge or your fundamental analysis knowledge, that is very, very important. Somewhere a very plain, simple Arima model is pure a price-based model, which may not be able to take care. So you may not get a very good accuracy when you apply a plain Arima model.
Correct. Right. So the next question is from Umar, and he asks, pandas, numpy and all that you mentioned in presentation are the libraries inside the Python. So anyway, it's a very simple question, so let me answer that. Yes, these are part of libraries inside the Python, and then we'll go to the next question. Frankie Chauhan has asked, what is the next updated software for financial analysis? Would you like to answer that question?
So I don't know what you mean by software, but basically, see, you do fundamental analysis, you do technical analysis. Now there are tools, and there are tools right from Bloomberg which cost you 60 lakh for an institutional membership. Tools like Screener which cost you 5,000 rupee per annum. So it depends on us what is the kind of analysis we want, whether we want just a P&L balance sheet analysis, or we want just the data, or we want data plus analysis, or you want data plus analysis plus scanners. So there are different kinds of tools in the market. Like if I talk of retail for financial analysis, in India you have Screener, you have Trendline, you have Stock Edge. If you want to go a little global, you have Ticker and all. When you think in terms of trading, whether you want to use for charting analysis, then you have your trading view. If you want to build technical scanners, you have charting. And then if you want to do something which is on the institutional side for retail, you have ACE equity and all, which comes around 1.5 lakh per annum. So it depends on what you want to do with it, whether you want to restrict that data, you want to go data plus insights, you want to do only fundamental plus technical, you want to build scanners. And then you have all this list of 15-20 softwares, and then depending on the price and utility, you need to take a call. So there is no one Bloomberg kind of go for tool, but these are the various tools, and each tool has own importance.
Correct. So there are a couple of questions from Srikant. We will just like maybe go for another 5 to 7 minutes, and then we will of course close the session. We have overshot the time already, so we'll quickly take 2-3 questions and then we'll close. Srikant has asked to become a quant trader. I mean, as he's from finance, what needs to be done after Python or during learning Python? And he has an additional question: are firms will accept non-IIT or IIM candidates for quant trading, that too fresher? If do, then please mention name of firms. Okay, very briefly, let me answer this question actually, and then you can add on to that if I missed something. So Srikant, see, Python is like just the basic tool. I mean, of course, that has to be learned in case you want to work as like a quant trader or any kind of advanced analytical areas of finance. But more than that, as Saurav has emphasized time and again, right? Only learning the tools actually will not help. The main thing is the domain knowledge. So if you want to become a trader, learn more and more about the tools that are used in trading. It can be the technical analysis knowledge, it can be the knowledge about the fundamental analysis, it can be knowledge about other quantitative models, it can be knowledge about machine learning. So the more things you know, the better trader you become, right? So the more things you can use, the better trader you can become. So, I mean, there is not one single formula to become a successful trader. There are so many areas you may learn, or you may want to concentrate only on one area, and then you may want to become a champion in that. So that's all up to you. But like to summarize, actually, the more knowledge you can gather in finance, market, and different relevant areas, economics also, then again the better chance of becoming a good trader, right? So if you want to become a quant trader specifically, of course, the learning the quantitative finance domain side also becomes important. So yeah, I mean, Python is just the tool, but yes, learning the domain is more important, because like where do you use the tool in? Do you use the tool to actually do the analysis in the domain? So domain knowledge is very important. Either do it along with it, or like before it, after it, that has to be learned. The domain, there is no escaping from that. And to answer your other question, whether firm accepts non-IIT IIM candidates for quant trading, that too fresher. See, you have to understand, I know where you are coming from. So a lot of people have this conception that like only people from IITs, IIMs are hired for quant trading. That's actually is to some extent it is true, but it is more true when it comes to hiring as fresher. It's very simple. The reason is there were very few courses which teaches the quant or this kind of domain, right? So essentially the companies, when they were hiring for quant or the quant trading or any other quant teams in India, they actually had to hire non-trained people. So when they were hiring non-trained people, whom do you hire? Since these are, we are talking about people like international banks and all leading consulting companies. So these are all rich guys, right? So they will hire the best resources, the best brains, which are easily trainable. So that's why they used to go to the IIT and IIM, not because they are trained specifically in this, but because they are supposed to be like the more intelligent guys who are easily trainable, right? But that does not mean that they are the only guys who are hired, particularly if you train yourself, right? So there are a lot of avenues to learn all these things. So if you have trained yourself and you have become prepared, there are a lot of people we see who actually are from very humble background sometimes, and then they have built this skill sets. They get hired. It's not that they are not hired. Particularly, see, the trading industry is an industry where I mean, it's a very black and white industry, right? So here, if you can show that you have the skill to perform, a lot of people will be willing to hire you. You may not be from IIT or IIM. So it's more about building your skills, showcasing the skill. Nowadays, showcasing is also very important. So once you build the skills, put those skills in your resume, put those skills in your LinkedIn profile, and then apply, right? I mean, there are a lot of people who actually make a career in quant trading and who are not from IIT and IIT. And to name firms, I mean, every firm which has traders, right? So it might be the international banks, it might be the prop desks, it might be the consulting firms. So all people hire, and not all of them are very fussy about IIT IIMs. Yes, sometimes for fresher hiring, as I said, they do. But if you have the skill set, you can actually make an entry as well, even if you're from a non-IIT, non-IIM. Do you want to add anything, Saurabh, to that?
No, I think you captured it well. The domain knowledge part is very important because even in data science, we are asked this question. It's a combination of three things. One is programming, second is maths or logic, and third is the domain knowledge. Until this, you have all three, it will not happen. So Python is just the programming part. Still, you need to take care of your mathematics and logic, and the domain knowledge, which is again, if you are a fundamental guy, then your financial statement, and if you are a trader, then the whole technical analysis field.
Correct. Correct. All right. So there are a lot of questions. We'll take only probably one or two quick questions. The course related questions, actually, we will take up one-on-one with you all. We will connect with you and we'll discuss with you the course related questions regarding Python or the other courses. But the general questions, let us take it quickly, because like for the paucity of time, now we are already 25 minutes past our allocated time. So I mean, just taking quickly questions like the one from Vaibhav. He says these days for credit risk modeling, they are asking for CA or CFA people who have knowledge about R and Python. Yes, Vaibhav. I mean, simply because, as I said, or rather even Saurabh has mentioned that like for advanced analytics nowadays, R was actually more used till 3-4 years back, but now, as Saurabh mentioned, Python is more in vogue and more in use now. But yes, this kind of tools actually are expected even if you are from a pure finance background. simple reason is because nowadays like a lot of modeling is done, even for pure finance analytics, a lot of modeling is done in Python and this kind of tools, right? So yes, that has become a de facto expectation, even if you are from a pure finance like CA, CFA kind of background. Quant profile is not part of investment banking. Santosh Kumar, again, let me take this question quickly. So investment banking is like actually a huge domain, Santosh. So and generally we segregate that investment banking industry also into two parts. One is the pure finance part, which is we call the corporate finance part, genesis of which is always the financial statement and economic and all this analysis, where you do company valuations and like M&A and like project financing, your PE, VC and all this kind of area. So that's one part of investment banking. Yeah, that does not involve quant that much, though some people have started using quantitative models even for like doing fundamental analysis. But in general, let us understand that like that's corporate finance, genesis of which is always the financial statements and like going forward. The other part of investment banking is the quantitative investment banking, right? Where actually you are dealing with quantitative modeling for valuations of derivative, model validation for derivative, risk management and all this part. So that part of investment banking would require quant profiles, and as Saurabh briefly mentioned, few companies actually for those kind of profile, they do not even hire any finance guy. They will hire a mathematician or like even a physicist as well. Okay, now the last question, and before we call it a day, how can a fresher break into quant finance field who do not have knowledge about regulatory guidelines, Basel III, because jobs ask for that? No, Basel III and all this is not like I do not think this is asked from like a fresher. I mean, of course, in case somebody has knowledge, that is always an advantage. But Basel III and all these are very advanced areas, and again, I'm not sure whether like freshers are asked about Basel III and all these norms. But if you want to break into quant finance, yeah, I mean, learn the basic skills which are required to become a quant, right? If you're a non-programmer, learn Python, deep dive into the mathematical side, and of course into the relevant areas of finance. And yes, we do have good courses in that, so which we can prepare you for this kind of roles. Last question is like Harsh, and we'll end the session with that. Saurabh, this is for you. For HFT, is Python good or C++ is better?
So one, I have never done high frequency trading. The reason being, I'm a retail investor, I don't work on the institutional side. Whereas HFT, this is more institutional, where your server speed and all becomes very handy. It's a fight of seconds, not even minutes. So it's a very different.
Actually, milliseconds and nanoseconds. Yes.
Exactly. So of course, I believe their algorithms and all. Algorithm is one part. Even the hardware and the infrastructure all becomes very important. So though I have never worked, and Nitish, you can emphasize more. But my understanding is Python is being used, but you will have more native languages being used there, because your typical C or Java, those kind of languages will be much more widely used. And same even with data science, I have seen like your Facebooks and all, they create their own languages because they try to solve very foundational problems. So that is how I'd like to see it, because they will have their own packages, they will have their own systems, because a lot of these things which we work on, that may not be valid for those kind of trading systems, because that's a question of speed rather than a lot of these things which we do.
Yeah, you are absolutely right. So just to add to that, I mean, if you talk about HFT and those kind of stuff, it's less of finance and it's more about the computation side of it, right? So as sort of rightly mentioned, it is more about like your speed of the system and all that. So it's like more of combination of software and hardware kind of thing. And for those kind of work, yes, still probably C, C++ and this kind of like native languages are more used, because it's all about speed. And I mean, C++ again definitely is a language where like is used more if speed is like is easy or concern. So for HFT and all, I mean, a lot of things, the basic things can still be done in Python, but for the actual implementation, yeah, I mean, they definitely would use C, C++ more than Python. That's correct. C++ is best for HFT. That's right. So I think I mean, it was a very engrossing session, and that's why probably we have overshoot the time by half an hour. I mean, thanks, Saurav, for taking your time out. It was really a lovely session, and thanks for like being patient and answering all these questions as well. Thanks for your additional time as well. So with that, we will end the session. Thank you so once again, Saurav. Thank you everyone for joining, taking your time out. In case anyone wants to have more discussion, you have our contact numbers. Please feel free to connect with us. We will be happy to discuss in more detail. Right. So with that, we will end the day session. Thank you.
Thanks a lot, Nitish. Thank you, everyone. Have a great weekend.
Yeah, you too. Thank you. Thank you.